Hello, everybody, and welcome. I'm Margaret Morales. I'm the director of the Carbon Program at GreenBiz, and I'm thrilled to be here with you all at our webinar. We're hosted today by BeZero, and we'll be talking about building confidence in early stage carbon projects. Prior to joining GreenBiz, I worked at a carbon project developer. And during my years there, it became so evident to me that there are a wealth of fantastic, high quality carbon projects that are slowed down or sometimes never get off the ground due to a lack of early stage finance. And if we could drive capital to those projects, we could accelerate progress for climate, nature, and people. So the good news is there is a growing trend of interest from carbon buyers and investors in connecting with carbon projects earlier in the development life cycle. We're seeing some early data that there's, it could indicate this is a growing trend from sources like MSCI. And for some carbon projects, I think there's some well-established tools for doing this, but for others, it's still relatively nascent. The tools for funding these projects in early stages. So the question I have for today for our panelists is what is actually happening on the ground? What's like under the hood and their experiences with the reality of this trend? Is it still an early theory? Is it moving into action? And perhaps most important of all, what are the levers we could do to accelerate this? So I'm thrilled to be speaking today with 4 experts on this topic. We have Ed Rumsey, who is the managing partner at Permian Global, which develops nature-based carbon projects. Jeremiah Lim is the director of sustainable and impact investing at Barclays and specializes in tech-enabled carbon removal projects. Joe Savari is manager at NG Impact, where he works with large corporate organizations transitioning to net zero. And Ronan Carr is the lead analytical officer at BeZero, which provides ratings and risk analytics on carbon projects. So we'll spend the first half of our time today talking about the state of play. What is happening with early stage project finance? I'll reserve our final 20 minutes for audience questions. So if you have questions as we go along, please put them in the Q&A box and we can see them. And I will try to get to as many as possible in the second half of our conversation. So without further ado, let's get right to it. I want to start with what our panelists are seeing on the ground right now when it comes to early stage project finance. And Joe, if you don't mind, I'm going to start with you. And what are you seeing from buyers? Are they interested? And what are the benefits to them of connecting with projects upstream?
Yeah, thank you very much. And thank you for the great introduction. So when we work with buyers, we're typically working with large corporate buyers. So I think that the first thing to say is there are many different types of buyer in the market. And thankfully, there are quite a few that are leaders that are really trying to push and enhance the industry and make sure that the carbon market delivers on what it promises. And from the perspective of those leading corporates that are really taking the climate transition seriously, investing in their own decarbonization alongside access to the voluntary carbon market, the reason they're pushing to go closer to the project developer is around risk mitigation. They want to mitigate their exposure to volatile prices over the next decade. They're looking to gain better control maybe over the governance of the project to make sure that they have clarity that no reputational damage will come back on them. And then probably there's a layer of narrative building and storytelling that gaining closer access to the project developer, delivering finance to where it matters most, making sure that the impact of the finance is being felt by the local communities, by those who are actually engaging in the emission reduction or the emission sequestration activity. That's where the finance is going. I think all of those pieces go towards controlling for price, supply, and reputational risks. And from a corporate buyer perspective, that's really what's making them want to act early and act early in a way that brings them closer to those most engaged in the projects.
Okay. Jeremiah, how are financial institutions looking at this? What are the benefits? And when are they interested in coming in on a project?
Thank you very much, Margaret. I think especially in engineered carbon dioxide removals, we're really at an inflection in 2020, late 2023, early 2024. The initial kind of wave of investment in the market really has been led by catalytic off-takers. So, the Microsofts of the world who have come in and essentially purchased credits, pre-funded some of them to allow project developers to get to scale. And a lot of that has also been funded by venture equity. But starting in 2023, we're really starting to see institutional investors, both from a fund perspective, so real money asset managers, infrastructure funds, as well as banks, come in and provide debt financing and equity financing for these projects. I think some of the key market infrastructure and tenants to project financing have started to become fulfilled. We now have large offtake contracts, which banks can factor demand over, which is a critical criteria. And some of those offtakes are starting to look like commercial agreements, right? Stuff that Joseph would be familiar with within the fuels market or within the power market, where you have offtake contracts that look like take-or-pay contracts with fixed prices that you can provide project or structured financing over. And that's one key development that we're starting to see that really is crowding in quite a lot of investment. But there's still a lot of work to do. The market is very illiquid at the moment. You can't have cross delivery of different CDR pathways. Even a BEX credit is not a BEX credit if it's from Drax versus Orsted versus Stockholm Exergy. And I think until we get a bit more cohesion around the market and there's a bit more certainty around cross delivery of assets, then that's the point that we're really crowding in more liquidity and bringing in a lot more debt into the market. Because right now, all the debt financing provided, us included, are small single-digit million facilities.
Okay. Ed, I'm curious, Permian Global develops the project. So what are you seeing on the ground?
Yeah, thanks, Margaret, and thanks to BeZero for having us. So there's a few points I'd like to make on here, and I'll try not to talk for the whole 45 minutes, but it's there's quite a lot to cover. So if we accept the premise that there is a trend moving towards pre-issuance finance, and we can challenge that a little, but I think we are seeing that to an extent for certain types of buyers. I would question why is it that we're seeing that, and I think there's two important points. I think the first is that if you're coming in early, you're probably looking to secure certainty of supply going forward, and that means you've probably got concerns that there's going to be sufficient supply going forward. And from our perspective, we exclusively focus on NCS projects, so it's conservation and restoration of tropical forest ecosystems. And just looking at the numbers on the Vera registry alone this morning, we've actually seen this year positive numbers. So through November, December, January, February, all record-breaking months in terms of retirements. But year to date on the Vera registry, we've seen 29.9 million tons retired against 21.6 million issued. So we're now starting to see end users surpassing what's available for issuance. But I think the really interesting flip, what we saw in terms of retirements, nearly 65% of those tons retired came from NCS projects. So that's obviously where the main demand wants to go, but less than 9% of the issuance came from that. So just over 1.9 million tons came from NCS projects. So I would question what's actually going on there. I think we can all be sympathetic to all of the standards in terms of the criticism that they had over the last couple of years and the growth and hence capacity constraints within them all. I think certain developers are potentially struggling to issue in any regular degree of frequency, or at least less predictable than historically. And so if we're talking about pre-issuance finance, I think there's certain characteristics to that sort of finance that we would really advise and strongly like to see, which is if there's less predictability, I think flexible delivery terms are really important. Depending on what level of project development you come in at, if you're talking about supporting a project pre-validation, the inception phase, that could be a 1, 2, 3 year lead period before you're issuing. And if I'm committed to deliver on the 21st of December 2027, I'm not entirely sure I'm going to be able to hit that date in the current market climate. So I think that's a really important point. I think there's one more point I'd like to make, which is, depending on the sort of organization that's providing that finance, often in return for upfront finance, pre-finance, pre-issuance finance, what the buyer is expecting to receive is not only security over or certainty over supply, it's also some kind of a discount on the price. And then that may be all well and good if you're buying through an intermediary broker reseller, but if you're directly engaging with the project developer, you've got to think about what that discount actually means. You may go back to your procurement team within a listed business and think you've got a really good deal, but what you're actually doing is you're taking finance away from activities on the ground, which are largely community development, community engagement, biodiversity conservation. So it's not necessarily the right strategy. I think if you want to avoid reputational risk, I would suggest aiming for fair market value rather than heavy discounts. I think I'll probably pause commenting there.
Okay, I want to dive deep into this issue of the risk of non-delivery. But before we get to that, Ronan, I want to hear from you. As interest moves upstream, what does that mean for rating agencies?
Yeah, thanks, Margaret. So, I mean, obviously ratings are, starting to prove themselves in the secondary market. We see adoption in marketplaces, in transactions, and we see a growing correlation between the prices of carbon credits and their ratings. But actually, the feedback we had last year was that activity was increasing upstream, and people were looking for a complementary tool across the full life cycle. And so that's why we introduced a complementary rating which we call ex-ante ratings, which is ratings for pre-issued credits. And that means we can now, provide our analysis across the full project life cycle, whether that's nature or tech-based projects, avoidance or removal. What we do with an ex-ante rating is, we're still asking the same question as we do with an ex-post rating is, what's the likelihood that this credit would achieve a ton? But clearly there's some of the same risks with issued credits, and there's some additional risks. The same risks are those kind of pillars of carbon efficacy that we look at in our ex-post rating. So additionality, the carbon accounting, the risk of non-permanence, and we do assess those clearly. And they help us to take a view on what we call the standalone carbon rating, which is our view on the inherent carbon efficacy, what we think the rating would be if these credits had already been issued. But we also have to assess the risk that the project fails or that you have non-delivery. And so we also assess that in our ex-ante ratings in what we call project execution risk. And to assess that risk, we're looking at things like technical risk, the risk associated with the project activity, whether that's technological, whether that's validation risk. We're looking at financial risk, so the risk that the project fails, doesn't reach full stabilization for financial reasons, trying to take a view there on the setup cost, the CapEx requirements, if there are any, and how those have been covered. And we're looking at legal and regulatory risk. So this could be anything from whatever the permits or licenses that are required to land rights can be quite an important risk factor for nature-based projects in some jurisdictions. Carbon rights as well, very topical. But also looking at stakeholder relations, particularly things like free prior informed consent and other stakeholder issues. We also look at the track record of the developer. Have they got an experience and a demonstration of prior success? And we look at operational risks once the project's likely to reach stabilization. So looking at all of these new risk factors, we can take a view on this risk of non-delivery, the risk of the project fails and doesn't get executed. And that way we can take a more comprehensive view of the risks for credits that have not yet been issued.
Okay, so this risk of non-delivery is so crucial to this conversation. So Joe, I'm curious how you see buyers trying to manage that risk, and in particular, what kind of price discount do they expect if they do some pre-issuance finance?
Yeah. So fundamentally, at least when we approach speaking with a project developer on a early engagement with pre-purchase, we begin our budget discussion around a cost plus model, which is very different than you would have a conversation with an intermediary or a broker on sort of a typical credit purchase. And so on a cost plus model, you allow for a certain community benefit share, you allow for the margin of the project developer. We've even seen index prices being set as a ceiling, and then there's a sort of discount off of a running index that allows you to at least share some of the rising carbon market benefit with the local communities. But I do think that there is a requirement for the project developer to understand that there's a level of risk assumption that is taken by whoever is financing the program that allows some level of preferential treatment, whether that's in price with a replacement credit guarantee is a function we've seen quite regularly, or also a level of control and governance oversight. If you are financing the project completely, do you have the right to intervene or change best practice to make sure that the project delivers on the type and quality of credit as you originally expected when you contracted originally? So what is the percent discount that you want on sort of credit contracting? It depends so much on the stage of the project, the value of the credit itself, and against what are you discounting? And what we see is from the CFO's perspective, they're not scared of today's prices. They're scared of the prices in 2030 and 2035 and 2040. And it's against that forecast that they want to discount and that they're willing to put sort of some capital at risk. Now, I think there's a question, and it'd be interesting to hear what Jeremiah thinks. Are corporates the right ones to understand that risk trade-off and the allocation of capital being, are they the ones best suited to play that role? And I think as the market matures, they shouldn't be. There should be some evolution of the market towards corporate offtake commitments over the long term that allow for financial institutions to deliver the early finance in a much more or less risky approach from that financial institution's perspective. So again, I really take Ed's point. You can't cut out the benefits of the carbon market from the local communities. That defeats the purpose, especially when it comes to attracting reputational benefit. That is so much of what these sort of voluntary carbon commitments are done for. But if you are taking risk, you need to have a reward for that. And so that reward can be guaranteed supply, replacement credit, could be a price discount against the forecast, but always recognizing there's a requirement for margin for the project developer who are doing incredible work and for the local communities for whom this project is most important.
Okay, yeah, Jeremiah, I'd love to hear what you think about Joe's question.
Yeah, no, I think Joe nailed it on the head, right? I think for a sustainable market to exist, we can't rely on corporate off-takers pre-purchasing and pre-funding all credit. Effectively, they're bearing all the risk for the project, right? Which is not a sign of a healthy, functional market. As he said, and I strongly believe this as well, we need to price risk appropriately, right? So the right projects get financed. And developers don't take undue risk just because they can. And we need a liquid market that is actively financing these projects so that they can get to that gigawatt scale we're all hoping for, rather than just a small pocket of corporate off-takers leading the market, which is absolutely important and catalytic, but is not the long-term solution. So I think that really comes back down to the question of what's the right point in which, and who are the right people to bear the risk. And within the deals that we look at, we're very, very focused on that, on risk sharing in the place that's best able to underwrite the risk, and the place that's best placed to price the risk. Because when you price the risk appropriately and you understand the risk that you're pricing, you're less likely to put in ridiculous volatility buffers because you don't understand what you're pricing. And that's why we believe that it's important equally for the financing market to develop, and as the insurance market, as the commodity traders like Andre to develop. Because who understands commodity prices better than somebody who trades it day in, day out? And equally, who understands catastrophe risks and weathering curves and all that kind of stuff better than an insurance company who already have financial models built to price that. And the other big element of it is that when you start looking at these on a portfolio basis, companies like Andre, companies, insurance companies, so on, when you price this on a portfolio basis, you stop pricing in as much idiosyncratic risk for each project developer, and you start looking at the substantive risk of the asset class as a whole. And I don't think we're there yet, right? It's still very much kind of concessionary capital, catalytic capital, trying to get projects started. And really, we're trying to shift the market more towards that commercial arm's length, scalable proposition that other market entrants, apart from just the first movers, can come in and participate in finance. And really, that's the challenge that we have today in bringing in liquidity to this market.
Okay, quick question, Jeremiah. Is having an offtake agreement in place like a non-negotiable for you before you would come in with finance?
In today's market, yes. To answer your question directly, the market is not yet at the stage where it's liquid enough that we can bank on secondary sales or primary sales of off-taking credits for large projects today. Of course, that comes with a caveat and an asterisk at the end. Oftentimes, we would do project financing for projects if you have a sufficient amount of offtakes to cover your debt service, for example, as a minimum criteria. So principal plus interest plus some amortization and overrun costs. So that is sufficient or necessary, but not sufficient to get a project finance.
Okay.
Certainly, I think most financiers, both on the equity and debt side, would struggle taking kind of merchant risk in the CDR market today just because of how illiquid it is.
Okay, we'll move to audience questions in a minute, but before we do, I want to talk about two levers that I think could accelerate this trend. And the first one is the ex-ante ratings that you mentioned, Ronan. I'm curious for you to talk a little bit more about how you develop those. And then Ed, I want to hear from your perspective if there's a benefit to you of having something like that in hand. So Ronan, first, if you could walk us a little more through how that works.
Yeah, of course. So, I mean, I think with pre-issuance ratings, there's a few use cases. If you're the project developer, you can use it to help, promote your project, but also as a risk management tool. If we highlight where we see the risk to carbon efficacy, because it's pre-issuance, it's potentially something that you can manage or mitigate. Equally for investors or pre-purchasers, we can feed into the due diligence process. I think the analytical process is a bit more involved than it is for issued credits, because for our ex-post ratings, we're largely taking the information that's available in the public domain in the project documents. For ex-ante ratings, we're sometimes dealing with projects that are at design stage, that are very early in their life cycle, right the way through to on the cusp of issuance. And so the availability of information or the format it's in can really vary. And so we do have a quite interactive process with project developers to make sure we've got all of the information necessary. Otherwise, it's a similar process to the way we undertake ex-post ratings, in the sense that we're doing our own due diligence on the project data, and then we're calibrating that against our own assessment of top-down risks, whether that's at a country level, methodology level, project type, etc. And the rating is obviously needs to be assessed in terms of the drivers of risk within it, right? So the headline rating itself is useful, but I think what's even more useful, especially for our ex-ante ratings, is understanding, well, where is the risk? Because you could have a tech-based engineered removal project which is completely reliant on carbon finance. It may be considered very additional, may be considered very permanent, but there may be significant project execution risk. On the other hand, you may have another project where it's much more nuanced discussion on additionality or on carbon accounting or on project execution risk. And so understanding where the risk is coming from can then help the other stakeholders either manage that risk or drive their own decision making, whether the investor, the project developer, the insurance company, or whoever.
Mm-hmm. Ed, is there an impact on you of having an ex-ante rating in hand?
Yeah, thanks, Margaret. Thanks, Ronan. I mean, we had a great experience working with the team at BeZero, I must admit. So through the course of last year, we did do a deep dive analysis on one of our projects, which is just coming to market now in Malaysia, in the state of Sabah. And so Ronan and his team had a thorough investigation over a number of weeks of all the different aspects to the project and our organization. And the resultant product is this sort of 110 plus page report with, as Ronan says, you have the standalone rating, but then it's the individual pillars that have been analyzed and rated within that report, which are actually incredibly valuable. And so you can use that in a number of ways for a number of different audiences. I think, as you quite rightly say, just including in a due diligence pack for any kind of debt or equity raise is really important when you're looking at the implementation risk. So what's the likelihood that the tons are actually going to occur at some future date? But then on the buy side, when you're talking to customers who are looking to secure those units, maybe even pre-issuance finance, then it's the carbon efficacy that they're really looking at, the carbon accounting aspect. What's the quality of the work that's gone into it, and therefore what's the probability of a ton CO2 equivalent been avoided, reduced, or sequestered? And that project actually, I just know, it came out in AA on the carbon accounting work, so we were pretty proud of that work.
Okay, one other lever, and we got a question about this and submitted before we started today. I think carbon credit insurance could be a lever, perhaps for driving more investment into early stage carbon projects, in part to manage that risk of non-delivery. And so, Joe, I'm curious if you hear interest from buyers in carbon credit insurance.
We do. We get asked, can we not insure this, quite frequently? And unfortunately, or maybe encouragingly, this is a space that is moving incredibly quickly, and you see a great deal of exciting new companies coming online over the past 24 months, probably. Unfortunately, they are limited in terms of the projects that they can apply themselves to, largely because so many projects' risk profiles are hard for them to understand. Now, some nature-based removal projects like afforestation fit certain insurance models that already exist, which is great because you tweak a few things and you can come up with a risk profile that a company can insure against. This isn't true for the majority of the sort of carbon credits that are on the market or even that are coming onto the market. And so we need to continue to see that evolve to really sort of take some shape. The other issue from the corporate perspective is that doing the financial analysis for investing early and then recognizing that there's some supply uncertainty, as Ed mentioned, around the delivery schedule and when those credits might actually come online, and then the uncertainty of regulatory changes in the specific geography in which you're working, and then the uncertainty of how much would the insurance cost on top of it. The business case for a pre-purchase against a discount or whatever the business case was from internally to the business, rolling in a brand new insurance scheme is quite complex. I imagine that this is going to change, and I hope that the insurance companies continue to target corporates as one class of clientele that can be insured against. Though I think as the market matures, it will be seen more and more from the investor perspective, insuring that pre-purchase agreement. And then the insurance for the corporate buyer being very much on the post validation stage of the project, in which the insurance is covering failure to issue, reputational issues or integrity issues that come out after the project has launched and after the credits have maybe been delivered, to cover that reputational risk, which insurance is moving into. That area of risk mitigation is harder to understand, is harder to draw up models against, and so is lagging behind that finance approach. All that to say, everybody's asking about it. So there is a clear shift towards understanding the risks in the market better, looking for ways to control them. And those insurance companies that are filling that gap now are filling a very sought after sort of problem statement that I think will and continue, or has already and will continue to evolve at great speed.
All right, so let's move to some other audience questions. We got one about the level of interest from investors in project co-benefits, whether that's biodiversity, community impact, or climate adaptation. So I'm curious, Ronan, if you could start, what do you see there?
Yeah, we do see a lot of interest in assessments on other risks. The BeZero Carbon rating is a carbon rating in the first instance, so it's primarily assessing whether the credit's achieving a ton or not. Having said that, within that analysis, we do assess social impacts because they often interact with carbon efficacy risks. So, what's the level of benefit sharing? If it's a community project, what's the buy-in from the local community? I mentioned earlier about free, prior, informed consent and other, stakeholder relations can be really essential to project effectiveness and project success over the longer term, which is a key driver of non-permanence risk. But increasingly, we're being asked by customers to provide complementary assessments of co-benefits or non-carbon risks as well. Some people are particularly worried about downside risks, so it's about kind of red flag assessments, particularly for at the kind of shortlisting stage for investors who are not yet in the full due diligence phase. And we're trying to react to that demand by expanding our offer to include assessments of safeguards in particular, but also co-benefits and SDGs and things like that. So that's an area that we're expanding into to kind of cater to that demand. Mm-hmm.
Jeremiah, are co-benefits part of the risks and benefits you evaluate?
I think it depends on what you mean by risk and co-benefits. I think historically, especially speaking generally in the green finance space or sustainable finance space, depending on who you ask, co-benefits and kind of reversals risk, call it that, or any other detrimental risk have often been viewed as a kind of through a do no significant harm or minimum safeguards lens. So you're looking at projects, the predominant benefit is the climate-based benefit, and the other co-benefits are really viewed as, well, how do we make sure that labor around that local area is not negatively impacted, or there aren't rights abuses, et cetera, as part of that project overall. I think increasingly so since, COP28, to be honest, there's been an increased discussion about just transition and how we move towards integrating some of these social aspects and other co-benefits, biodiversity since last year's COP as well on biodiversity. How do we integrate that into the environmental attributes? So we're looking at it holistically as a just transition narrative rather than just a climate narrative. But I don't think there's necessarily a simple framework on looking at projects holistically today. It's much easier to say, I'm investing in this project because it removes a ton of carbon than it is to give a holistic, qualified answer on the multiple benefits. Although investors do see that as an upside to the extent you achieve the same amount of carbon removals, but have co-benefits. In the case, I think one of the audience members mentioned enhanced rock weathering, where you do see co-benefits in addition to carbon removed. As long as you're comparable from a levelized cost of carbon perspective, then obviously the co-benefits gives you a one-up when you look at vis-a-vis another pathway.
Okay, Ed, I have a question for you here. Does having access to early stage finance or pre-purchase agreement change how you develop a project, or does it have an impact on, what kind of quality measures you can implement in that project?
That's a really good question, Margaret. Actually, I mean, my brain was still in the co-benefit space, but I'm moving on to that point. It doesn't, and it shouldn't. Let me expand upon that. It's important to have the sufficient working capital in place before you develop a project. You shouldn't be out there tin rattling in the middle of the project and struggling to finance your operations. And what I would be concerned around for sort of smaller single project developers is that if you're entirely financed by, as Jeremiah warned of, entirely financed by pre-finance from some corporate that wants 100% of your offtake, then often that finance can be incredibly restrictive. It's going to be sort of stage milestones, and you're going to really struggle, and you'll be micromanaging cash flow through the life of the project. And then actually the quality of the project can potentially suffer because of the nature of the sort of geographies that you work in, particularly for the types of projects that we focus on. You need to be relatively agile. You need to be able to course correct. You need to be able to address concerns as and when they arise. And if you're doing that against sort of drip-fed finance, that can be really challenging, I would imagine.
Okay, thank you. So this may be a question for you, Jeremiah, and I think you've touched on this a bit, but perhaps you can add some more color, which is what components of project implementation plan make investors more confident in making a pre-issuance agreement?
I think the key part of your project implementation plan is really kind of having robust milestones that are very clearly defined and having a clear pathways with credible partners towards that, right? So when you look at it from both a debt and equity perspective, people care about overruns, people care about performance risks, and people care about you ultimately achieving the commencement of operations of that project, right? When you look at it from an engineering perspective. So similar to how you look at an oil and gas project or an offshore wind project, you're really going through that same kind of engineering process life cycle. So going through your kind of feasibility analysis, making sure the economics work, going through FEED class 1, that gives you some certainty bands around what the project will actually cost, making sure you sign your offtakes beforehand, or a large majority of your offtakes beforehand, so you stabilize your revenue of the project, and signing long-term feedstock agreements, whether it's power in the case of DAC, or feedstock agreements for biomass in the case of BECCS, or rock in the case of enhanced rock weathering, and the O&M contracts, so operations and maintenance contracts that go alongside that. So there really are quite a lot of moving parts, just going at a very superficial level from a project development perspective that needs to be managed in parallel. But ultimately, the gold standard you're trying to achieve really is to make the project look as much like a fixed income project as possible. So effectively, you're running the project with high quality counterparties, managing all aspects of it with a strong track record. And ultimately, the revenue looks like, it's effectively fixed for the long term. And that's ultimately how you get the lowest pricing. Then, obviously we know in the market today for engineered CDRs, we're not there. But then it's starting to look at the trade-offs within your project development lifecycle, and making educated trade-offs, right? There are no solutions, just trade-offs. And really kind of deciding within that realm of trade-offs and within that realm of partners, who you are willing to work with and how much you're willing to pay to get certainty versus trading that off for something, less than certain.
I think no solutions, just trade-offs is going to be my new life motto. I'm going to remember that. Thank you. Okay, Joe, I think I'd be curious to hear your thoughts on this question, which is, everything we're talking about here is making decisions with limited information, making decisions on things that haven't happened yet. So what are the most effective ways to assess the quality of projects that haven't started or are in a very early stage? Like, what are the things you hear buyers looking for?
This is a great question. Thank you very much. I think it goes to quite a lot of what the conversation has been so far today, and Ed just brought up how complex some of these projects can be, especially in the places where they operate. And I think fundamentally, in order to understand how a project is going to function before it's begun, you need to know that you trust the entity that's going to carry it out. You have to understand the local context of the area in which the project is going to function. You have to understand the underlying technology that is being employed that is going to deliver the emissions change or the sequestration. And then you have to be able to compare between the 5 or 6 different proposals on your desk then and sort of assess the differences between them. And for any one entity to do that, or from the corporate perspective, a procurement team that has never seen a carbon offset before, that sort of work is nearly impossible, which for one thing, I think the work that BeZero is doing with the ex-ante rating is great. It sort of democratizes that assessment in a way that hasn't been done before. But I think even better than that is sort of delegate that project financing conversation to those who are doing it as their day job, that there's a function within that entity that analyzes projects and looks for risks and understands that exact project technology in that geographic region and how it's going to be employed with partners that they know and understand. And so I think that while there are these great corporate benefits around storytelling and price mitigation, and there is a great rationale for moving closer to project developers, that can still be maintained while looking for other partners to guarantee or assess the quality of projects as they kick off. And the final point that I would add, and this is something I sort of always mention when speaking with our clients, is you need to diversify. Being wholly exposed, married to a single project is super risky. And from a corporate perspective, doing this due diligence and understanding the project for 5 or 6 projects to deliver you credits throughout your sort of next 5 years, 10 years is quadrupling, quintupling the effort that you need to put in. So there needs to be, in my opinion, a sort of diversified managed portfolio of carbon credits from a trustworthy partner who is doing the due diligence on your behalf, finding the right projects to funnel to you. And I think that the tools and the concepts that have been discussed here and the complexity of the projects cannot be escaped. You have to embrace that uncertainty. You have to embrace that complexity, and you have to find the right minds, whether they're Eds or Jeremiahs or Ronins, to help frame those risks in a way that then can be controlled for.
Okay, we have 2 minutes left, so I'm going to sneak one more question in here under the wire, which is about the role of MRV. And especially as MRV gets more precise, could it be another tool for reducing some of this upfront risk and uncertainty? Ronan, I don't know if you could start us off on that one.
Yeah, for sure. I mean, I think there's a lot of exciting developments in carbon markets. MRV is one of them, you know, in the nature-based space. Geospatial technology has really moved on dramatically in the past 5-10 years, but not only in nature-based. I think if you look at digital MRV and cook stoves or other project types, the level and quality and reliability of the data that we're getting from newer projects is really important and really makes our job easier. You know, ultimately, there's always inherent uncertainty in a carbon project, and that's one of the reasons we would say you need ratings, because you can never be 100% certain that the project or the credit is achieving a ton. But the better the reporting, the better the quality of the data, the more you're squeezing that uncertainty. And that's good for the developer because it's maybe going to push them higher up the rating scale, and it's good for the market, clearly. I think what's interesting, there are other developments in the market too. You've got new standards, new or updated methodologies, industry initiatives like the core carbon principles, and all of these things, and also new project developers and lots of new entrants. And all of these things are driving a hope that the incoming supply will be better than the legacy supply. But it's hard to really know that in advance. And I think this is where we think ratings can play a role, is to provide some kind of benchmark against the existing marketplace. And it's a hard metric, it's an independent metric, and it's fungible across all project types. So yes, short answer is better technology, more MRV is fantastic.
Okay, I hate that we're already at time, but this has been so fun. So thank you to all of you for joining. I think this is maybe one of the most important conversations we could be having when it comes to carbon markets right now. And thank you to everybody for attending. This was so many good questions we couldn't get to. And finally, a big thank you to the BeZero team for organizing and all the work behind the scenes to make this all seem so seamless. So thanks to you all. I'm sure we'll see each other in more conversations in the future.